The Federal Reserve Chair stood at the podium in Jackson Hole, delivered a speech that financial markets treated as a masterclass in central bank communication and received near-universal praise from economists, analysts, and financial journalists. The stock market rallied. Bond yields moved in the predicted direction. The financial press wrote thousands of words about the precision of the message and the credibility of the plan. And underneath all of it, hiding in plain sight in the data that everyone in that room had access to, but nobody chose to address directly, is a structural trap of two. $1 trillion that makes the stated plan not just difficult to execute, but mathematically incoherent. Not politically difficult, not technically challenging, mathematically incoherent. Here is the number that illuminates the problem. The Federal Reserve currently holds approximately $1 trillion in assets on its balance sheet, down from the $9 trillion peak reached in April 2022, the consequence of 2 years of quantitative tightening that was supposed to normalize monetary conditions. Within that $1 trillion portfolio sits $1 trillion in mortgage-backed securities that the Federal Reserve has no realistic mechanism to sell, no viable timeline to allow to mature, and no capacity to simply hold indefinitely without creating the exact inflationary dynamics that the rate hiking cycle was designed to eliminate. This is not a theoretical problem or a future risk. It is a present-day structural constraint that puts the Fed chair's stated normalization plan in direct contradiction with the balance sheet reality that the Fed itself publishes every Thursday on its website. The mainstream financial press covered the interest rate story. They covered the dot plot projections. They covered the inflation trajectory. Almost none of them covered the $1 trillion trap, because explaining it requires confronting an uncomfortable truth. The Federal Reserve may have successfully reduced inflation from its 9.1% peak, but in doing so, it created a balance sheet problem that limits its ability to prevent the next inflationary episode and reduces its options for responding to the next recession to a narrower and less effective set of tools than it has deployed at any point since the 1930s. What follows is the mechanism, the history, the numbers, and specifically what this means for your financial decisions in the next 24 months. To understand the $1 trillion trap, you need to understand how the Federal Reserve acquired those mortgage-backed securities in the first place, and why selling them is structurally different from selling the Treasury securities that make up the rest of the Fed's portfolio. When the COVID pandemic triggered financial market seizure in March 2020, the Federal Reserve responded with the most aggressive monetary expansion in its history. Over the following 2 years, it purchased approximately $3 trillion in agency mortgage-backed securities, bonds backed by home loans guaranteed by Fannie Mae, Freddie Mac, and Ginnie Mae, in addition to its Treasury purchases. The explicit purpose of MBS purchases was to suppress mortgage rates below where they would otherwise trade, reducing borrowing costs for homeowners and stimulating the housing market as a channel for broad economic stimulus. The strategy worked as designed. 30-year fixed mortgage rates fell to 65% in January 2021, the lowest in the recorded history of the U.S. mortgage market. The housing market exploded. Home prices increased by approximately 43% between March 2020 and June 2022, according to the S&P Case-Shiller Home Price Index. American homeowners accumulated approximately $11 trillion in additional home equity over that period. But the mechanism that made MBS purchases so effective at stimulating the economy is precisely the mechanism that makes selling them catastrophically difficult. When the Fed purchased those mortgage-backed securities at 65% yields, it was purchasing bonds backed by mortgages with approximately 3% interest rates. Those mortgages were refinanced at historical rate lows, locked in for 30 years, and are now sitting on the balance sheets of millions of American households as essentially permanent, long-duration, fixed-rate liabilities. The homeowners have no incentive to refinance at 7% when they have a 3% mortgage. The mortgages are effectively frozen in place. The bonds backed by those mortgages will not be repaid through refinancing or prepayment for an extraordinarily long time. The Federal Reserve's MBS portfolio has an effective duration of approximately 9 to 12 years under current interest rate conditions, compared to the 2 to 3 year effective duration that prevailed when rates were falling and refinancing was commonplace. Translation: the Fed bought short-duration mortgage assets in a falling rate environment and woke up holding extremely long-duration mortgage assets in a rising rate environment. It is the worst possible combination, and attempting to sell those assets at anything approaching their face value requires finding a private sector buyer willing to purchase a 3% yield bond in a market where comparable new mortgages yield 6, 8 to 7, 2%. The implied price discount to make that transaction rational for a buyer is approximately 30 to 35% of face value, according to analysis published by the Bank for International Settlements in their 2024 annual economic report. Apply that discount to $1 trillion. The Federal Reserve's MBS portfolio is carrying a mark-to-market loss of approximately $630 to $735 billion at current interest rates. The Fed does not mark its portfolio to market. It carries these assets at amortized cost. But the economic reality of the loss exists regardless of how it is accounted for. And here is the mechanism by which this unrealized loss creates a binding constraint on monetary policy. The Fed's ability to conduct quantitative tightening, actively selling assets from its portfolio to reduce the money supply, is effectively limited by its unwillingness to crystallize a $600+ billion realized loss that would require Treasury Department recapitalization and create a political crisis of unprecedented proportions for an institution whose operational independence depends on maintaining the appearance of financial soundness. The trap is set. The Fed cannot sell the MBS. The MBS will not mature for a decade, and the excess liquidity represented by those assets remains in the financial system, providing a persistent inflationary floor that the interest rate mechanism alone cannot neutralize. There is a historical precedent for this situation that most contemporary analysts are either unaware of or choose not to discuss because its implications are deeply uncomfortable for the conventional narrative of central bank competence. In 1951, the Federal Reserve was locked in what historians of monetary policy call the Fed-Treasury Accord dispute. Following World War II, the Fed had committed to maintaining artificially low interest rates to help the Treasury finance its wartime debt, a policy that prioritized fiscal convenience over monetary stability in a manner that had produced persistent inflation throughout the late 1940s. The Treasury had accumulated such large volumes of low-yielding bonds on its books that allowing rates to rise to market-clearing levels would have required either massive fiscal adjustment or explicit acknowledgement that the government's debt management strategy had created an inflation problem it could not address without accepting significant financial losses. The 1951 accord that resolved this standoff produced a decade of significantly elevated inflation expectations, reduced Federal Reserve credibility, and constrained monetary policy options that contributed directly to the economic instability of the 1950s. It took a full decade for the Fed to reestablish the policy credibility that the wartime balance sheet distortions had undermined. The present situation is structurally identical in its mechanism, if not its precise parameters. The Fed's MBS portfolio is the 21st century equivalent of the wartime treasury bonds, a legacy of deliberate balance sheet expansion designed to facilitate financial conditions that were appropriate at the moment of acquisition but have become problematic given the subsequent evolution of economic conditions. The constraint they create is precisely the same. The central bank's future policy options are limited by the financial reality of past portfolio decisions. The critical difference is scale. The entire Fed balance sheet in 1951 was approximately $45 billion. The problematic portion of the present Fed balance sheet is $1 trillion, more than 46 times as large in nominal terms and representing a significantly higher percentage of GDP when measured against the contemporary economy. The 1951 constraint took a decade to resolve and required sustained inflation as part of the resolution mechanism. Applying even a partial analog to the present situation suggests that the resolution of the MBS trap will require either an extended period of above-target inflation, a significant disruption to the housing market, or some combination of fiscal and monetary measures that fall well outside the conventional monetary policy toolkit. Think about what this means for the Fed chair's stated normalization plan. The plan assumes that rate reductions over the 2025 to 2027 period, combined with continued balance sheet runoff through maturity redemptions, will gradually normalize monetary conditions without reigniting inflation. The historical parallel and the balance sheet arithmetic both suggest this assumption is incorrect. Rate reductions will stimulate demand. That is their mechanism of action, while the MBS portfolio ensures that excess liquidity remains in the system to amplify that demand stimulus. Cutting rates while holding $1 trillion in frozen MBS is not normalization. It is applying the accelerator while the brake is stuck in position. The $1 trillion trap is not an abstract balance sheet problem. It has a direct transmission mechanism into the real economy through the housing market, a mechanism that is already operating and will intensify as the Fed attempts to execute its stated normalization plan. Here is the dynamic. The Fed's MBS purchases suppressed mortgage rates to 65%. Those rates enabled a housing market boom that locked 3 million American homeowners into sub-4% mortgages, according to the Federal Housing Finance Agency's mortgage market data through 2024. These homeowners have a powerful financial incentive to stay in their homes, what economists call the lock-in effect, because selling means giving up a 3% mortgage and acquiring a 7% mortgage for their next property. The National Association of Realtors estimates that housing inventory as of early 2025 remains approximately 38% below pre-pandemic normal levels, with the lock-in effect responsible for the majority of the shortfall. The consequence is a structurally constrained housing supply that keeps home prices elevated and keeps shelter inflation embedded in the CPI at rates significantly above the Fed's target, regardless of what the Fed does with short-term interest rates. This is the feedback loop. Fed MBS purchases created the conditions for the lock-in effect. The lock-in effect constrains housing supply. Constrained supply maintains shelter inflation. Shelter inflation, which carries a 34.9% weight in the CPI. Daker senden daker for danser, nanses, dases, natsi, yes keeps headline inflation above target. And the Fed cannot address shelter inflation without either reversing the MBS purchases, triggering the balance sheet losses described earlier, or raising rates high enough to break housing demand, an outcome that would cause a recession severe enough to impose political pressure that the Fed's operational independence may not survive. The IMF's Article 4 consultation on the United States, published in June 2024, flagged this exact dynamic, noting that shelter costs had become the primary structural impediment to achieving the 2% inflation target, and that resolution required either significant time for market adjustment or policy actions beyond the conventional monetary toolkit. The IMF's preferred diplomatic language for what it cannot say directly, that the Fed's own balance sheet is partly responsible for the inflation problem the Fed is attempting to solve, is visible throughout that document if you know where to look. The Urban Institute's Housing Finance Policy Center published complementary analysis in March 2024, estimating that the lock-in effect will persist at significant scale until mortgage rates decline below 5%, at which point enough homeowners find selling financially attractive to normalize inventory levels. But if the Fed cuts rates enough to bring mortgages below 5%, it stimulates demand in every other sector of the economy simultaneously, potentially reigniting the broader inflation that the rate hiking cycle spent 3 years suppressing. The Fed is being asked to thread an impossibly narrow needle, cut rates precisely enough to unfreeze housing supply, but not enough to stimulate broad inflation while holding $1 trillion in mortgage assets that prevent the natural market clearing process from functioning. The Federal Reserve does not operate in isolation. Its policy options are constrained and enabled by the fiscal environment, the government's revenue, expenditure, and debt management decisions, in ways that have become increasingly binding as federal debt has expanded. And the fiscal environment, as of 2025, is delivering constraints on Fed policy options that are genuinely unprecedented in the post-war era. The Congressional Budget Office projects that federal deficits will average approximately $8 trillion annually through 2030 under current policy, a level of structural deficit that requires the Treasury to continuously issue new debt regardless of whether economic conditions would ordinarily call for fiscal restraint. The federal government will need to refinance approximately $28 trillion in debt between now and 2030, including the rollover of existing obligations and new deficit financing, according to Treasury Department issuance projections. Now, consider the interaction with the Fed's balance sheet situation. When the Fed was conducting quantitative easing, purchasing Treasury securities, it was absorbing supply from the Treasury market and suppressing yields. That absorption provided the Treasury with artificially low borrowing costs that enabled the deficit spending of the 2020 to 2022 period at what will in retrospect appear as extraordinarily favorable interest rates. When the Fed conducts quantitative tightening, allowing or actively selling Treasury holdings, it removes a buyer from the Treasury market at precisely the moment when the Treasury needs to sell more securities than at any previous point in American history. The arithmetic creates a structural conflict between the Fed's stated goal of balance sheet normalization and the Treasury's fiscal financing requirements. The BIS estimated in their 2024 analysis that the combined impact of Fed QT and increased Treasury issuance requires the private sector to absorb an additional $7 trillion in Treasury securities annually compared to the 2019 baseline. In an environment where foreign central banks are reducing their Treasury holdings, as documented in the Treasury International Capital data showing approximately $800 billion in reduced foreign official holdings since 2021, that private sector absorption requirement can only be met at higher yields, which means higher borrowing costs throughout the economy, which means more deficit spending on interest payments, which means more Treasury issuance, which means higher yields again. This is a debt spiral dynamic. It is not yet a crisis, but it is a mechanism that, if left unaddressed, leads to outcomes that are significantly more disruptive than the moderate inflation and elevated interest rates that the mainstream policy conversation is focused on. The Laubach-Williams estimates of the neutral interest rate, the rate that neither stimulates nor restrains economic growth, have increased from approximately 0.5% before the pandemic to approximately 2% in 2024, suggesting that the economy's underlying requirements for capital have increased in ways that structurally support higher interest rates for an extended period. If the neutral rate is genuinely higher than the Fed's plan to cut rates toward the 2.5 to 3% target range may deliver stimulus into an economy that does not require it, embedding inflation at levels that require another tightening cycle within 3 to 4 years. This is not an abstraction. The $1 trillion trap has specific, quantifiable consequences for decisions you are making right now about savings, debt, investment, and career strategy. The mortgage market is the most direct transmission channel. If the lock-in dynamic persists as the BIS and IMF analyses suggest, keeping mortgage rates elevated, constraining housing supply, maintaining shelter inflation above target, then the conventional financial planning assumption that mortgage rates will return to the 4 to 5% range within 2 to 3 years is almost certainly wrong. The University of California, Berkeley, Haas School of Business Housing Finance Research Group published analysis in 2024 estimating that mortgage rates below 5% are unlikely before 2027 under the base scenario, and that the rate path depends significantly on whether the Fed resolves its MBS portfolio problem through maturity runoff, slow, active sales at deep discounts, crisis triggering, or a novel mechanism that has not yet been announced, politically complicated. Anyone making a major housing decision on the assumption of near-term rate normalization is planning around a scenario that the Fed's own balance sheet makes structurally implausible. For financial asset allocation, the implication is that the secular decline in interest rates that drove equity valuations upward from 1981 to 2021, a 40-year bull market in financial assets powered by falling discount rates, is wasme almost certainly not returning in your investment lifetime. Valuation models that use 2 to 3% long-term interest rate assumptions to justify current equity market prices are using inputs that the fiscal and monetary dynamics described in this analysis make structurally unjustifiable. The Shiller cyclically adjusted price-to-earnings ratio for the S&P 500 sat at approximately 34 times earnings as of early 2025, the 97th percentile of historical valuations, exceeded only during the dot-com bubble. That valuation level is defensible if interest rates decline toward their pre-pandemic norms. It is not defensible if the $1 trillion trap keeps monetary conditions structurally tighter than the Fed's stated targets imply. For cash and fixed income, the implication is that the traditional advice to reduce bond duration in a rising rate environment requires updating for the specific dynamics of the current MBS trap situation. Treasury inflation-protected securities, TIPS, are mathematically advantaged in the scenario where the hidden shelter inflation mechanism keeps real consumer price increases above the levels the Fed can address with conventional tools. The TIPS break-even rate, the market's expectation of future inflation embedded in the price difference between nominal treasuries and TIPS, significantly underprices the shelter inflation persistence dynamic described in Chapter 3. TIPS priced at the current break-even of approximately 3% are effectively offering insurance against a 3 to 4% inflation scenario at below actuarial pricing. For career and compensation strategy, the most important implication is the timeline. The convergence of the MBS trap resolution dynamics, the treasury refinancing wall, and the commercial real estate repricing cycle all point toward 2026 to 2027 as the period of maximum systemic stress, the point at which the structural contradictions in the current monetary framework most likely force policy decisions that create economic disruption. Decisions made in the next 18 months, salary negotiations, debt refinancing, asset allocation, will be made in a relatively stable environment that the subsequent period may not offer. The Federal Reserve is an institution of extraordinary competence operated by thoughtful, well-intentioned policymakers who have access to more relevant data than any individual investor or analyst can aggregate independently. The $1 trillion trap they face is not a failure of intelligence or intention. It is the consequence of policy choices made in a specific historical context, the COVID emergency that made sense in that context and created structural complications in the subsequent context. Central banks have faced similar balance sheet complications before. The Bank of Japan has navigated yield curve control dynamics for 3 decades. The European Central Bank constructed creative mechanisms to manage its sovereign debt portfolio during the European debt crisis. Solutions exist or will be invented, but solutions take time. And the period between when a structural problem becomes visible and when a workable solution is implemented is precisely the period of maximum disruption for ordinary financial decisions. The Jackson Hole speech was not misleading. The plan described is real and is being executed. What the speech omitted, what the CEO aforementioned, what every press conference and congressional testimony omits, and is an honest accounting of the two. $1 trillion constraint that limits how that plan can actually unfold. The Fed chair's plan will be modified. It will be extended, it will encounter the housing market feedback loop and the fiscal financing requirements and the balance sheet arithmetic described here, and it will adapt. What it will not do, given the structural realities of the MBS portfolio, is proceed cleanly from current conditions to normalized monetary policy on the timeline that the dot plot projects and the markets have priced. The numbers are on the Fed's website every Thursday. They have been there for years. The $1 trillion trap is not hidden. It is simply not discussed. And understanding what the numbers mean before the plan meets the structural reality it has been avoiding is the only reliable preparation available.